Just a week after the Silicon Valley Bank collapsed, on March 19, the international investment bank Credit Suisse was inexplicably acquired by its longtime rival, UBS, for a meager $3.2 billion. It should be noted that Credit Suisse, unlike Silicon Valley Bank, is a global systemically important bank with over $1.5 trillion in assets under management. This acquisition is significant considering that Switzerland's GDP is only $800 billion, which is equivalent to 2 years of Credit Suisse's assets under management. Moreover, in February, Silicon Valley Bank had a market value of $18 billion, which is equivalent to 5 Credit Suisses, yet the acquisition price was only agreed upon by UBS after the Swiss government bundled a series of equity gifts. The collapse of this former giant is attributed to a simple phrase uttered by the chairman of the Saudi Arabian National Bank, who said, "Absolutely not." Anyone who has followed financial news over the past 2 years may have heard about Credit Suisse's negative press. Many have been saying that it is on the verge of collapse every year, yet it has managed to stay afloat until now. It's difficult to explain why it's struggling and what caused its downfall. Today, let's interpret this deep mystery together. Credit Suisse and its old rival UBS have always been deeply tied to Switzerland, and their glory and collapse are intricately linked to the country as a whole. Today, let's not only talk about the rise and fall of Credit Suisse, but also delve into the historical background and the complex connections between Credit Suisse and the Swiss government. How did such a huge entity like Credit Suisse end up collapsing step by step? Credit Suisse was founded in 1856, yes, you heard that right, 1856. Let's fast forward to 1934, when Switzerland passed a very important law called the Federal Banking Act. The core of this law was 2 words: secrecy. In essence, Swiss banks cannot disclose customer information to anyone, including any third-party organizations, whether it is the US government, the United Nations, or the Swiss government itself. If a client has not consented or there is a criminal complaint, I can simply say no to any request for client information, otherwise I may violate this Federal Banking Act. We often hear that Swiss banks are safer than banks in other places, not primarily because their safes are thicker than elsewhere, but because of this secrecy provision. Once this secrecy provision became part of federal law, it naturally attracted many clients from all over the world who had high demands for confidentiality. As you may have guessed, many of these clients had dirty money, such as tax evasion, money laundering, drug trafficking, and so on. Even during World War II, the Nazis stored a large amount of gold bars in Swiss banks, and Hitler himself deposited 1.1 billion Reichsmarks in UBS. But the Swiss people's thinking is also reasonable. They believe that they must remain neutral, right? I'm just a bank, I just need to protect the confidentiality and property of my clients. As for whether the money is clean or not, I don't care. You see, it has such a secure secrecy provision, and at the same time, it is a neutral country with stable politics. In addition, Switzerland itself is relatively developed. Its banking industry skyrocketed after World War II, making it the world's largest offshore financial center. At the beginning of 2000, a quarter of the world's cross-border private wealth was concentrated in Swiss banks. 2 giants, Credit Suisse and UBS, emerged among the many Swiss banks, with Credit Suisse ultimately failing and UBS acquiring it. In the early days, these 2 banks had a love-hate relationship, with their headquarters located side by side on a square in Zurich. Their business models and customer bases were very similar, and their employees often jumped back and forth between them. If you had to point out the difference, most of the time, UBS was larger than Credit Suisse. Credit Suisse played more extravagantly, particularly in its investment banking department, but overall, they were very similar. Looking specifically at Credit Suisse in the early 2000s, it was its most glorious period in terms of global influence, although it wasn't at the top of the heap. Credit Suisse was a well-known name, and looking at the 2007 league table that compared investment banks and various business performance metrics, Credit Suisse didn't rank first, but it ranked in the top 5 in areas such as high-yield bonds, IPOs, and mortgage bonds. It also had a presence in other areas. Expanding on this a bit, some people want to find work in investment banking. I'm not particularly familiar with Europe, but in the United States, the large investment banks are referred to as bulge bracket investment banks, and people have a vague sense of their ranking in their minds. They are divided into 3 tiers: Tier 1, Tier 2, and Tier 3. Tier 1 is basically made up of American investment banks, such as Goldman Sachs, Morgan Stanley, Citigroup, and Bank of America Merrill Lynch. The second tier is made up of some of the larger European investment banks, such as Deutsche Bank, Barclays, UBS, and, of course, Credit Suisse. This classification isn't absolute and is a bit like a ranking in the realm of reputation. As we just mentioned, Credit Suisse's investment banking business was its most glorious, but what it was most proud of was its private banking and wealth management businesses. After a reorganization in the early 2000s and with the help of Switzerland's secrecy mechanisms, Credit Suisse's private banking business maintained nearly 20% growth, even during the 2008 financial crisis, surpassing its longtime rival UBS and reaching a market value of $80 billion. Credit Suisse was one of the investment banks least affected by the crisis and did not receive any government bailout, unlike UBS, which was rescued with government aid. However, Credit Suisse's troubles began to unfold after the crisis, and its gradual decline continued for over a decade. The collapse of Credit Suisse started with its private banking business, which was suspected of protecting a significant amount of black and grey industry money, causing dissatisfaction among governments worldwide. Various international organizations launched investigations into Credit Suisse's business practices, mainly focusing on tax evasion. In May 2014, Credit Suisse was found guilty of helping U.S. citizens evade taxes and was fined $2.6 billion. The U.S. Department of Justice had been imposing fines on large investment banks since the 2008 financial crisis, and other banks such as UBS and Société Générale were also fined but not convicted. Ironically, after being fined, Credit Suisse's stock price did not drop but increased slightly. The market had already known that Credit Suisse had helped clients evade taxes, so the conviction and fine did not come as a surprise. The market even considered the fine to be relatively lenient and acceptable. This penalty can be considered a highlight moment for the U.S. Department of Justice, and also marked the beginning of the Credit Suisse meltdown. In the same year that Credit Suisse was fined, 2014, Switzerland signed a U.S. law called FATCA. Simply put, this law requires countries to provide account information of U.S. taxpayers to prevent tax evasion, which forced Switzerland to break its previous banking secrecy laws. In March 2015, Credit Suisse appointed a new CEO named Tidjane Thiam. His resume is impressive and he is a typical and capable banker. On the day Thiam was announced as the CEO, Credit Suisse's stock price rose by 7.5%, indicating market optimism about him. However, what followed made headlines in major media outlets: the Credit Suisse espionage scandal. Thiam and a Credit Suisse executive had never gotten along, and the fact that their villas were adjacent to each other didn't help. In early 2019, at a cocktail party at Thiam's home, they almost got into a fight over trivial matters such as noisy renovations and trees blocking each other's views. As expected, the executive was subsequently pushed out and joined UBS, bringing along a group of former Credit Suisse executives. To collect evidence that the executive was poaching employees, Credit Suisse hired private detectives to secretly track them, but they were caught red-handed on the street. Later investigations found that this was not the first time Credit Suisse had engaged in such activities, as they had previously monitored executives and third parties 5 times. This incident had little to do with Credit Suisse's business, but its negative impact was severe. It made headlines for days, forcing Thiam to resign. It seems that Credit Suisse is prone to encountering strange and unpredictable events. But wait, there's more. After that, a new CEO came in with ambitious plans for reform, including restructuring and cost-cutting measures. However, 2021 turned out to be a painful year for UBS and Credit Suisse, with their stocks underperforming. In 2016 and 2017, the two companies were similar in performance, but the real turning point was 2021. At the beginning of the year, a supply chain finance company called Greensill, which had a close relationship with Credit Suisse, collapsed, causing the bank's clients to lose $2.3 billion and damaging Credit Suisse's reputation. Then, in March, there was a major event that rocked the global financial industry when family office Archegos Capital suffered a $20 billion loss in just 2 days due to overleveraged positions in a few stocks. Its investment manager, Bill Hwang, became the fastest money-losing man in history, and Credit Suisse was caught in the crossfire. Hwang had secretly engaged in large-scale derivative transactions with 6 investment banks, including Credit Suisse and UBS, for several years. However, none of these banks realized that Hwang was juggling 6 banks simultaneously, and their positions eventually became excessively concentrated in a few stocks. To win more of Hwang's business, Credit Suisse aggressively provided him with high leverage, which other banks wouldn't dare to match. Before 2021, Hwang had been on a winning streak and had made a fortune worth over $20 billion. Credit Suisse alone could earn several tens of millions of dollars in service fees from him in a year. However, when the market had a small dip in 2021, the excessive positions created by Hwang's 6-bank juggling act led to a stampede in the 6 banks, resulting in a near-death experience for all of them. Goldman Sachs emerged relatively unscathed, but UBS lost over $800 million, Nomura lost over $2.9 billion, and Credit Suisse, which had the largest positions and was the greediest, lost $5.5 billion in just 2 days. This was not only their entire annual profit but also became a major financial headline. Just now, amidst all the explosive events, I picked and chose what to say because it's really too complex otherwise. Credit Suisse provided services such as money laundering to various smugglers and drug traffickers, and the multi-billion-dollar fines that followed every 6 months were no exaggeration. Who held Credit Suisse stocks over the past 10 years had to have some serious willpower, especially after the Bill Hwang incident, which was followed by another major executive reshuffle and a new CEO who promised reform, turnaround, and delisting. However, coupled with global changes such as the Fed raising interest rates and tightening global liquidity, in the fourth quarter of last year, the market slowly eroded the trust that Credit Suisse had accumulated over the past century, and a large amount of deposits and high net worth clients began to withdraw from Credit Suisse. In just 1 quarter, Credit Suisse lost more than a third of its savings, about $140 billion. Rumors about Credit Suisse collapsing were increasingly circulating in the market, and by the end of 2022, its credit spread had soared to over 300. You can understand it as the odds of betting that Credit Suisse is about to collapse, and they had risen significantly. In order to attract customer deposits, Credit Suisse raised the interest rate on 3-month deposits to 6.5%. This CEO was quite unlucky, but he managed to pull in a big fish. The Saudi Arabian Sovereign Wealth Fund invested $1.5 billion in Credit Suisse and took a 9.9% stake. Unfortunately, you thought you were buying the bottom, but in fact, Credit Suisse had no bottom. In March of this year, we all know that the Silicon Valley bank run triggered a high degree of nervousness globally about the banking system. On March 9, the U.S. Securities and Exchange Commission halted the release of Credit Suisse's annual report, citing issues. Then on March 15, the chairman of Credit Suisse's largest shareholder, the Saudi National Bank, was asked in an interview about Credit Suisse's liquidity problems and whether there would be further assistance. He replied, "The answer is absolutely not." Of course, he also gave his reasons for holding just 9.9% at the moment, as going over 10% would be very problematic. It's a bit too radical to say, absolutely not. Is it really necessary to be so assertive, especially in such a tense market? He probably didn't realize that the financial industry is now like the entertainment industry. You have to be extremely careful with what you say. You never know which sentence could be misunderstood and cause the market to explode. It was precisely because of that, absolutely not, that Credit Suisse's stock plummeted 20% that day. By the way, the outspoken chairman of the Saudi National Bank was fired shortly after this incident. When the Swiss government saw that Credit Suisse was really struggling, they panicked. After all, Credit Suisse is a bank that is too big to fail for Switzerland. The next day, they quickly released a statement to assure everyone that with the Swiss government's support, Credit Suisse would not fail. They had prepared 54 billion Swiss francs to prevent any liquidity problems. This stabilized the market sentiment and the stock started to rebound. People had become used to Credit Suisse having problems every few days, so it felt like another wolf was coming. But in a few days, everything was back to normal. However, the government realized that the market had lost all confidence in Credit Suisse, and even if they managed to stabilize it this time, its downfall was just a matter of time. The government didn't want to be the one to bail out Credit Suisse, so they announced publicly that they would provide assistance, but behind the scenes, they gave UBS and Credit Suisse a strong command. They told them to come to an agreement within 48 hours, which was just 3 days later. UBS was required to acquire Credit Suisse, and this was not a negotiation, but a notice. So, UBS, Credit Suisse, and the government engaged in a long 48-hour negotiation, and it was time for the game that everyone loves and I love the most. Let's take a look at the positions and competition of these 3 parties in this game. Firstly, from Credit Suisse's perspective, they obviously don't want to be sold, especially to a direct competitor. They are hoping for government intervention to save them, but the government has made it clear that this is a notification, not a negotiation. So, they don't have much room to maneuver and are hoping to sell for a high price, ideally based on the current market value of around $7-8 billion USD, with a slight discount. On the other hand, UBS is willing to acquire a competitor but wants to do it at a low price, and time is a critical factor. UBS is thinking, the government has given us a weekend to take on this massive responsibility. Credit Suisse is in dire straits, heavily indebted and complicated, and it takes more than a weekend to buy a house. How am I supposed to know how much it's worth? How about I offer 1 billion Swiss francs, equivalent to $1 billion United States dollars? This $1 billion United States dollars is roughly 1/8 of Credit Suisse's stock price 1 month after it had suffered continuous plunges. Credit Suisse must be furious at this offer, feeling insulted, thinking, are you kidding me? You are insulting me with this offer. UBS responded, you're almost out of business, and you're still picky. This wasn't even our business. we can't make a higher offer in such a short period. From a third-party perspective, in situations like this where a company is in dire straits and is about to be acquired, the stock price may be halved. Of course, there is a lot of room for fluctuation. UBS is under pressure to act fast, and this may explain why they're taking a hardline approach. However, $1 billion does seem low and a bit insulting to Credit Suisse. So, it all depends on the government's attitude. From the government's perspective, UBS and Credit Suisse definitely don't want either of them to fail. As for the specific amount of money involved in the transaction, the government doesn't really care. However, the problem is not that simple because UBS and Credit Suisse are not just two small Swiss companies. They are both international investment banks with shareholders all over the world, most of whom are not Swiss. For example, Credit Suisse has a large portion of capital from the United States and Germany, in addition to the Saudi National Bank and Qatar. Therefore, when the Swiss government is forcing the enforcement of these two international companies, it is actually pressuring both sides into negotiations, without even allowing the boards of directors to refuse. Therefore, if the negotiation is not handled well, such as if the price is too high or too low, it could lead to one side's shareholders becoming agitated. This could potentially cause negative sentiment in the global financial market towards other Swiss companies, which may result in decreased investment. From the Swiss government's perspective, neither side's shareholders can be offended, but Credit Suisse still needs to be rescued. Therefore, even though the negotiation involves tens of billions of dollars and a few $1 billion, the negotiation must continue. So, what can the government do? Under this kind of pressure, the Swiss government came up with a solution, which is quite cunning. They said, if we can't afford to offend these shareholders, we must offend someone. Why don't we offend this creditor instead? The government just waved its hand and said it's gone. Credit Suisse's AT1 bonds with a face value of $17 billion, which means Credit Suisse doesn't have to repay the $17 billion of bonds. It's embarrassing for the investors who bought these bonds before because they're mostly professional financial institutions with stronger risk-bearing capabilities and smaller reputational risks. And the government also provided UBS, the acquirer, with a liquidity guarantee of 100 billion Swiss francs and a guarantee of 9 billion Swiss francs for Credit Suisse's unreliable assets. So, UBS, you can offer a higher price with these conditions, right? This will make both sides happy. Finally, on March 19, just 5 days after this absolutely not incident, the two parties reached an agreement. UBS announced that it would acquire Credit Suisse, a century-old investment bank, for $3.2 billion. Here, Credit Suisse gave UBS a gift and paid $14 billion. Of course, this number can't be calculated so simply. You can feel how big a mess Credit Suisse is in. And what is the concept of this $3.2 billion acquisition price? It's a quarter of the stock price before this market crash, 1/10 of the stock price a year ago, 1/30 of the stock price 10 years ago, and 1/100 of the highest stock price in 2007. Okay, now that it's finally sold, what's the problem with the bond default we talked about earlier? In general, the priority of bonds is higher than that of stocks, which means that when a company has problems and needs to be liquidated or loses money, the first priority is to protect the money of bondholders, and the losses should be borne by the shareholders. However, the government's operation this time means that the priority of the bonds is lower than that of the stocks. Of course, the ones who were chosen to default were the lower-level bonds called AT1. But it's still a relatively unusual operation. It seems that the Swiss government is giving up the bondholders to protect the shareholders, as the influence and public pressure of the shareholders are greater. So the bondholders are outraged and are now joining together to sue the Swiss government. It's not just AT1 bondholders like Credit Suisse who are unhappy. Even the shareholders are not happy. For example, the Saudi National Bank said, "I didn't approve this. You sold yourself at such a cheap price. I invested $1.5 billion just half a year ago and said, absolutely not. And now it's only worth $500 million, without even a penny of profit. Do you mean to say that UBS has hit the jackpot and made a killing by acquiring Credit Suisse? Not necessarily, as it is hard to tell whether this acquisition will be a blessing or a curse, considering the deep-rooted corruption that has been exposed in Credit Suisse. Initially, UBS's stock rose for 2 days after the announcement of the acquisition, but it fell back down once the market calmed down. The merger has also led to UBS's asset management scale reaching $5 trillion, which is 6 times the GDP of Switzerland. Here's a small piece of knowledge I would like to add since some of my viewers might be professionals. The management assets, and deposits of a bank are very different. For example, at the end of 2022, Credit Suisse managed assets worth 1.3 trillion Swiss francs, with total assets of 530 billion Swiss francs and deposits of only 245 billion Swiss francs. This is because some of the money in the managed assets belongs to the customers and is held by the bank, but it does not belong to the bank's assets. So, there is still a significant difference between the two. I am emphasizing this because I have seen many materials that frequently confuse management assets and total assets. So, if you are someone who is particular about numbers, please take note. So, what does it mean for UBS to acquire Credit Suisse? It does not mean that Credit Suisse will disappear. Rather, UBS will become a shareholder of Credit Suisse, and the previous Credit Suisse shareholders will hold a portion of UBS's stocks. Although Credit Suisse will not disappear immediately, it announced the layoff of 9,000 employees right after the agreement was reached, and UBS might need to lay off more employees once it understands the company better. UBS spent some money to acquire a large group like Credit Suisse, and it will undoubtedly pick the more valuable parts, such as wealth management or clients, while disposing of investment banking and market segments that do not make money. After all, UBS did not spend much money on this acquisition, and it is certain that the Swiss government will do everything possible to protect UBS since it has become a crucial bank for Switzerland that cannot be allowed to fail. Alright, now let's analyze why Credit Suisse collapsed. Can we really attribute it to just an absolutely not incident? It seems like that was only the tipping point. Saudi Arabia can't be blamed for this either. Could it be due to issues with liquidity management like Silicon Valley Bank? No, that's not it either. Despite its stock price dropping 99% after the financial crisis, Credit Suisse's various risk indicators, such as liquidity and capital adequacy ratios, were not only up to par but also strictly regulated by Europe and the US. In this environment, Credit Suisse was still doing okay. Take Silicon Valley Bank as an example. It went bankrupt because it didn't hedge against interest rate risks. But Credit Suisse, as an internationally significant bank, was subject to regulations that required it to hedge against such risks. Additionally, the assets it managed did not decrease in recent years and even increased until 2022. Its customer assets and indicators were also up to par. So how did it end up collapsing so spectacularly? In essence, it's because the market has slowly eroded Credit Suisse's confidence in a series of scandals. Personally, I believe that for a bank, the most important thing is the market's confidence in it. Customers, for example, trust that their money is safe with you or trust you to handle their transactions. I just want to feel secure. I don't need a bank to be good at all kinds of complicated strategies, like hedge funds, or have super high returns or be innovative. Just be steady and professional. You see, why did Credit Suisse have one scandal after another? Helped clients evade taxes, tracked former employees, and had trading failures. It seems like each incident has nothing to do with the other. Is it just bad luck for Credit Suisse? I personally feel that it is very likely because the long-term accumulated internal management issues have slowly eroded the company's culture. Its risk management is very weak, not only in terms of market risk as required by regulators, but also in terms of operational risk, moral risk, credit risk, etc. Whether it is helping clients evade taxes or providing a huge credit risk exposure to Greensill, these are all for the sake of making money regardless of the risks. When one or two scandals are exposed, customers may not run away at this time, but the bank's credit will be lowered. After that, attracting talent will also be difficult, and financing costs will increase. Even providing many derivatives pricing to the market will be affected. After that, making money will be even more difficult, and employees will be more eager to make money, forming a vicious cycle. Although Credit Suisse has trillions of assets under management, it has not made money since 2011. So, to summarize, the underlying reason for Credit Suisse's collapse is that it prioritized pursuit of profits over risk management for an extended period of time, leading to one after another scandal and eroding market confidence. This ultimately resulted in its decade-long decline. Some may ask whether it will trigger a Lehman moment in the global financial market. While Credit Suisse's collapse appears to be a special case, other unexpected scandals could occur due to the high level of tension in the market. It is important to note that market confidence is the underlying connection between these scandals. As for where the next scandal will occur, some speculate it could be Deutsche Bank, US commercial real estate, or Japanese government bonds. What is your perspective on this?